Welcome everyone to Copenbarger's presentation on the big beautiful bill, the big, the bad, and the ugly. My name is Kevin VandenBroeke. I am an attorney here at Copenbarger in the Business, Tax, and Advanced Planning Department. Uh, Tonight's not going to be about politics or opinions. It's going to be understanding how current tax law is going to affect real families and what smart proactive planning will look like. We're going to emphasize that good planning is going to start with a conversation with your legal, tax, and financial advisors. On that note, just a brief disclaimer before we dive in. As legal and tax professionals at Copenbarger, we must stress that the information presented today is general and for educational purposes only. Your situation is always going to be unique and require legal, accounting, and tax advice that is specific to you. So please take what you learned today as a jumping off point to help inform your discussions with your advisors. We will be taking questions, so feel free to put those into the chat or the Q&A section on the Zoom, and we'll be addressing those at the end of the presentation. There will also be a survey following this presentation. Please make sure you click that and fill it out and let us know what you think. So here at Copenbarger, we have a large team of attorneys helping you everything from estate planning to tax to business planning to estate administration, probate, litigation. So large team of attorneys here ready to help you. Here is a picture of our entire staff from a few years ago. Let's see. Friendly faces in there, and those are all the folks that kind of back you up here at Copenbarger. We have offices throughout California, 8 main offices. Our main office is in South Coast Metro here in Santa Ana, California. We also have offices in San Jose, Temecula, Santa Cruz, Pasadena, San Diego, Sacramento, and Laguna Hills. So today we are going to discuss the big beautiful bill, which was passed in July of 2025, the why and the what, the big or the good about it, some bad things, some ugly things, and what next steps you can take to make sure you're prepared for these changes in the law. We are going to focus specifically on how this will likely impact California families, just because we are California attorneys and we are here addressing our California clients. So why California families? California families have strong earnings, appreciating real estate, and some of the highest state taxes in the country. These factors make federal tax changes more impactful here than in many other states. What might look minor on paper, we're seeing can actually materially affect family wealth over time. California families generally have high incomes and high property values, already significant exposure to taxes here in California. And we have a lot of families that are asset rich, but cash flow conscious. So, a lot of property assets, but maybe not so much liquid assets there. So tax changes can have a big impact on their planning. So the Big Beautiful Bill refers to the One Big Beautiful Bill Act, which was a sweeping federal law signed in July of 2025, which combines major tax cuts, spending changes, and budget measures as part of the federal budget reconciliation package. It extends many of the 2017 tax cut provisions from the Tax Cuts and Jobs Act and makes them permanent. And it also adds several new tax breaks, such as higher standard deductions, expanded child tax credits, and temporary exclusions for taxes on tip and overtime income. Beyond taxes, the law also includes changes on spending on programs like Medicaid and SNAP, expands immigration enforcement funding, and raises the federal debt limit, making it one of the largest pieces of the 2025 legislative agenda. Let's talk about the big, some of the good big changes we saw come out of the Big Beautiful Bill. First, the Big Beautiful Bill helps reduce income tax pressure by locking in the lower individual tax rates and preserving the larger, more favorable tax framework from the 2017 Tax Cuts and Jobs Act. So taxpayers aren't facing a reversion to higher rates after 2025. Without this passing, we were going to see, starting in 2026, a reversion to the pre-cut Tax Cuts and Jobs Act regime, which would have had a significant impact on families filing their tax returns for the 2025 season. It also increases key credits and deductions that directly lower taxable income. For example, the child tax credit is being increased to $2,200 per qualifying child, and that's going to be indexed for inflation over time. So it's going to boost benefits for families. In addition to the standard deduction, which is remaining at that higher Tax Cuts and Jobs Act era level, the bill adds temporary targeted deductions for working Americans. It says it's up to $25,000 of qualified tip income and $12,500 of qualified overtime pay that can be excluded from taxable income for the tax years 2025 through 2028. There are some income caps on that where it starts to taper off, but that is a provision that will be in there for the next few years. Additionally, seniors age 65 and older can also take an additional $6,000 deduction or a $12,000 for couples on top of the standard deduction for that same period. And that is going to start to phase out at certain income levels as well, but it's currently there, and it doesn't matter whether or not you take an itemized deduction or the standard deduction on your tax return. So for seniors over age 65 and up, a definitely good benefit for them there. These changes are going to lower the effective tax burdens for many families and workers, especially those with children, the seniors, or variable earned income. The Big Beautiful Bill permanently raised the federal estate and gift tax exemption amount to $15 million per individual starting January 1st, 2026, which was up from the $13.99 million in 2025. Those changes were part of the original Tax Cuts and Jobs Act. They were scheduled to sunset at the end of 2025 and would have fallen back down to the $5 million index for inflation, but for the Big Beautiful Bill, which came in and made those increases permanent. They will start to index on inflation starting this year moving forward, so it'll keep going up year after year. What this does, it allows a single person to transfer up to $15 million estate and gift tax free through lifetime gifts or at their death, and married couples can shelter up to $30 million before federal transfer taxes apply. This is going to significantly reduce estate tax exposure for many families in the long term. It's also going to create several new planning opportunities for folks that want to take advantage of these, all-time high exemptions. The estate and gift tax exemption is one of those use it or lose it type tax exemptions. So if the law ever were to change to bring it back lower, but you've already planned and used up some of your exemption, they can't take it away from you. So that is a very good time to plan right now when the exemption is so high. The Big Beautiful Bill doesn't just lower taxes. Like I said, it creates powerful planning opportunities for families who act strategically. With the historically high estate and gift tax exemptions now extended, individuals can make large lifetime gifts without triggering transfer taxes, giving families far more flexibility in how and when they pass on wealth. It's going to allow parents and grandparents to help children and grandchildren earlier, whether that's funding for their education, helping with a new home purchase, seeding businesses, or moving appreciating assets out of their estate while values are lower. Early transfers can reduce future estate taxes while letting families see the impact of their planning during their lifetime. And finally, the bill gives families a chance to lock in today's favorable rules. By using exemptions now, you can hedge against future law changes, inflation adjustments, or political shifts that could reduce these benefits later. For many families, this is a rare window to implement proactive long-term wealth strategies with greater certainty and control. Not everything is great about the Big Beautiful Bill. However, there are some trouble areas, which we're going to refer to as the bad. And it's important that everyone is prepared for some of these changes so they know what is coming their way, whether it be now or a few years from now when these laws may change or sunset again. One of the biggest downsides of the Big Beautiful Bill is that it keeps the cap on state and local taxes, or the SALT deduction. Prior to the Big Beautiful Bill, the SALT deductions were limited at $10,000. The Big Beautiful Bill did, in fact, raise it up to $40,000. So there was an increase on the amount of state and local taxes you can deduct on your tax return. But there's still a limit. And there was a lot of fighting during the legislative process when this bill was getting ready to pass about where that cap should be, with more of the higher income states and the higher tax states fighting to remove those deductions. And then it was just a matter of the give and take, where to take money off the table, where to put money on the table, which led to them coming up with a $40,000 cap. That $40,000 cap is scheduled to sunset in 2030. So it does create, it creates an issue where folks may become used to taking a larger deduction and having less of a tax burden over the next few years. And if you're unfortunately not paying attention, come 2030 filing season, you're going to get hit with higher taxes without knowing about it. This hits California homeowners especially hard. Here in California, we have some of the highest property values in the country. In addition to that, we have high state income taxes and then just local assessments on as well. It's going to have a lot of California taxpayers paying well above the SALT cap, but you won't get to deduct the full amount on your federal tax credit for those costs. In practical terms, it means higher effective federal taxes for many middle to upper income Americans and Californians. For professionals, the impact is often even more painful. Physicians, attorneys, business owners, and dual income households frequently face high state taxes and expensive homes, making the SALT limitation a real drag on after-tax income. While the bill does offer tax relief in a lot of areas, and it does give some relief on the SALT limits, it does remain a major pressure point for California families. But don't worry, there are some workarounds for it and some tax planning you can do, and we'll cover that a little bit later. One of the issues with any new tax legislation is they can generally be considered temporary and uncertain. We saw that through, I'd say, the last 10 years or so. We've seen new administrations come in and take, there's always a discussion on, what should change in the tax code. It's one of the most frequently changed pieces of legislation here in the country. And it seems that depending on what group we have kind of having the majority, there's major changes to come around. Waiting for that clarity often results in a lot of missed opportunities. Good planning is going to be flexible and adapt to the change rather than betting on one future tax regime. So right now is really the time to get a solid plan in place, both on the income tax planning side and your estate and gift tax planning side, to make sure you are staying ahead of the changes and making sure that your plans work for what your goals for your legacy are. For the ugly, what could go wrong from the big, beautiful bill? It's creating a large sense of security, which is often false. In meeting with my clients, I've noticed a lot of folks thinking, these limits are now so high, the $15 million or $30 million for married couples, I don't need to worry about this. There's really nothing, no planning I need to do because I'm not going to hit assets of those values. We're on the exemption, we're fine. What this ignores often is that assets are generally going to continue to grow. We've seen, while the market fluctuates, we've seen a record market for the last decade or so. It just keeps going up. Property values keep increasing. Really, estate tax is only one risk that we have here. But as assets continue to grow, families need liquidity. There's family conflict, and then there's outdated documents that can cause really big problems for families that aren't really looking into their plans and creating something new and something that's going to last the tail of time. Some common issues that I've been seeing in the wake of the big beautiful bill and also just in estate planning in general, a lot of older trusts are drafted under different rules. If a trust was drafted more than 20 or so years ago, the estate tax exemption at that time was all the way back in, the $1 million level index for inflation. So we've seen a dramatic rise from $1 million all the way up to $15 million over the last 15 years alone. And a lot of clients don't update their documents as often as they really should when there's these major changes. So the old planning may be more conservative than it needs to be, placing assets into credit shelter trusts or different types of irrevocable trusts where you don't have control over your assets as much, or you're no longer receiving the income from your assets or the benefits from your assets. And under the current tax regime, that's no longer needed. So updates are really important to make sure that you are doing all you can for your property and your assets. Businesses and real estate aren't being integrated into estate plans. Oftentimes you see, a basic living trust set up, but folks won't actually title the name of their property into the trust, or they won't change the name of their business into their trust. or they made plans for these businesses and they had originally planned to do some estate or gift tax planning with them, but in light of the new higher limits, they don't think their business will ever have a value of 15 million or higher. So they're not planning for the future generations and the future legacy to take over. And you'll see families completely wiped out by estate taxes upon the main family's passing because there were no plans in place to help pay for some of those taxes or to really secure the next generation's place in those businesses. So we're really seeing multiple times where people are coming in just uncoordinated or with outdated plans. Planning is easier before laws change. With the estate and gift tax exemption in particular, there was a lot of planning being done prior to the 2025 Big Beautiful Bill or the sunset of the Tax Cuts and Jobs Act, increase of that exemption. So you saw a lot of people rush to plan for that higher $13.99 million limit when they thought it was coming back down to about 5,000 index for inflation. So it would have been about a 7 million or so. Reactive planning that you saw in the wake of that is just people getting ready, to try to maximize their assets as much as possible. Time is going to be the most valuable asset you have in planning, especially when it comes to estate and gift taxes. Most plans take a long time to reach their kind of full benefit. You're usually talking about 3 to 5 years or so in order to get your assets into the types of trusts or the types of entities they need to be outside of your estate, but also realize things like basis step up and other ways to transfer that wealth to the next generation. So right now, unfortunately, with the Big Beautiful Bill, we see certain income tax side of things scheduled to sunset in 2028, 2030, and so on. That's going to create a lot of uncertainty for folks that are planning for these tax breaks, and they're kind of going to vanish. And sending them on 2028 or 2030, it really kicks the can down the road to the next administration, to really kind of be at the whim of whoever we vote in as president next and what their plans are for their tax regime. So a lot of uncertainty in the air right now. So now is the time to take advantage and plan as you can. So what can you do in light of these changes and possible future changes? Right now, we're really advising our clients and our families to review their existing estate and tax plans. Stress testing under different tax scenarios is extremely important, just so you can see, a 5-year picture, a 10-year picture, or even a 1, 2, and 3-year picture with some of these scheduled to sunset sooner rather than later. Really everyone's plan is going to be unique to them based on their types of income, their asset holdings, their family structures, etc. Good planning doesn't predict the future; it prepares for it. Really, the best thing any of you can do is schedule a consultation for a personalized review, whether it be with your attorneys like me, whether it be with your accountants and CPAs on the income tax side, and your financial advisors to plan for tax efficient assets, moving forward. The goal here is, education, clarity, and confidence in your plan. So really understand what you're doing and how you're moving forward with it. There are several different types of trusts, entities, and plans available to you to plan for these changes in the estate and gift tax law, as well as the income tax law. As I mentioned a bit earlier, adjusting your revocable living trust, if you have not had your revocable living trust updated, I'd say at least in the last 5, pushing out maybe a little bit longer, 10 years or so, it's probably time to make a consultation to sit down with your estate planning attorney, and really kind of go through what changes in the law there have been, what changes in your family circumstances there have been, what changes in your goals there have been, and really make sure your plan at a base level is working for what your goals are. In addition to that, there's lots of different types of irrevocable trusts, which are great for both estate and gift tax planning, as well as income tax planning. So the goal with estate tax planning, generally for those that are going to have assets over the 15 or $30 million of married, that level, really the goal is to get whatever assets above that level you can outside of your estate for tax purposes, so your family and your beneficiaries aren't paying estate taxes when you pass away. That can be done during your life using gifts. So the gift and the estate tax exemption are tied together. So it's that same $15 million limit for 2026. Um, all different types of trusts that I use. One of my favorite is what's called a SLAT, or a spousal lifetime access trust. What that does, it allows you to create an irrevocable trust. You move your assets into that trust. You functionally lose a lot of control over that asset. That's one of the downsides of having to do these types of irrevocable trust planning. But with a spousal lifetime access trust, what you do is you keep your right to the income on those trusts. You generally give your spouse that income right to life. So while the trust and your assets may no longer be paying income to you, it is to your spouse, and hopefully things are good enough where your spouse is then, combining that income with you. Also, CRTs, or charitable remainder trusts. There's many different types of charitable trusts. Here at Copenbarger, we love helping our clients with charitable remainder trust just because it's a great way to give back, but also realize, tax and estate benefits from it. How charitable remainder or charitable lead trust generally work is you create an irrevocable trust that is going to have a charity as your end beneficiary during your lifetime, or for a term of 20 years, or you can set up for your kid's lifetime, etc. The charitable trust generally is going to pay the income from those assets to you, and then at your death, or the death of the income beneficiary, the trust is going to make a donation of whatever principal is remaining to a charity of your choice. That can be a private foundation, that can be a recognized 501c3, as long as it meets IRS requirements, and then you make sure there's enough remaining in the trust following that time. Charitable trusts are a great tool. Also, from the income tax planning side, charitable remainder trusts are a great way to kind of stretch out your income taxes. For example, if you are sitting on highly appreciated stock assets, let's say you bought Microsoft back in 1989, you bought it for, it was probably trading for $1 a share. Who knows? I don't know that off the top of my head. But now it's worth considerably more. If you were to sell that, you're going to have a very large capital gain. Yes, capital gains are taxed at a lower rate than ordinary income, but it's still, if you sold all those assets in 1 year, you could be sitting on millions of gain that needs to be tax paid in 1 year. If instead you were to transfer those assets to a charitable remainder trust, the trust can sell those assets tax-free to the trust. That since it's a charitable trust, it's not paying any income tax. Then as you take distributions of that income over time, you're only picking up the tax for the portion that was distributed to you in that year. So it's a really good way to stretch out large capital gains over time. You get an immediate income tax deduction for the value of the contribution to the charitable trust. And then you also get that income back over time. And then after the period is ended, your charity of choice gets the benefits. So it's an amazing one. SRTs, or standalone retirement trusts. In the wake of the Secure Act, you're not seeing standalone retirement trusts used as often, but they are still a great tool for 401ks, IRAs, etc. If this trust is used, you can no longer stretch out the time for required distributions. It's still generally going to be that 10 years for non-spouses. But what you can do is, if you have younger beneficiaries or a special need beneficiary, you can pool those assets in the trust over time and let them take it as needed. But it's still, the plan still has to be distributed out within that amount of time, but it lets you kind of have a bit more control over where the assets go once they're funded into that trust. Q-tip trusts are just a way to move assets into your spouse's estate after you pass, and still give them access to it, where you're taking advantage of their exclusion instead of your own. And then the grantor retained annuity trust is a fantastic tool for those with a net worth far exceeding the exemption. So those, above the 15 or $30 million. What a grantor retained annuity trust allows you to do is move a significant portion of your assets into an irrevocable trust that is required to pay you an annuity from those assets for a certain term of time. The value of the assets being transferred to that trust are generally subjected to it's a calculation looking at what the remainder in that trust is anticipated to be on the conclusion of that grant term. And then that discounted value, because it's not going to be the same amount that you actually contributed, is what you have to report for gift and estate tax purposes. So, for example, you have a $30 million business, you decide to put it into a grant, but you're taking 5% of the value of that annually for 20 years. you're probably looking at about only $20 million in gift and estate tax exemption being used up for that $30 million gift. And at the end of that time, you can have it go to your beneficiaries. It can be put into another trust until you're passing. So grants are a great tool and one that I love to use for some high net worth estate planning as well. When it comes to the income tax planning side of things, now is really the time to sit down with your CPAs, your financial advisors, your attorneys, whoever is kind of part of your advisor group for finances, and really make sure that your assets are doing as much for you as possible, making sure you're having the type of income tax effective assets placed into your portfolio to make sure you're getting ahead of some of these changes. For example, we had mentioned the 65 and up deduction, that you can take as part of the big beautiful bill. That starts to phase out based on your modified AGI. It starts to phase out about 75,000 for a single person, 150 for a married couple filing jointly, and then phases out completely at the 175 or $350,000 level. What that means is if you are taking distributions, from your retirement plans or from some of your other assets that push you above that level, you're not going to get that break anymore. So if you don't necessarily need that income, or if you can structure it in other ways where it's not going to impact your modified AGI, it's a great tool to make sure you're paying as little tax as possible. But that's going to depend on your asset makeup, what your needs are, and it's really a plan that needs to be put in place with your financial team. Also, what we're seeing with the incredibly high unified credit is the reemergence of what are called downstream basis trusts. What you're seeing here is you're not usually the parent generation, but usually the child's generation. They are taking their assets, using their extremely high unified credit of the $15 million and gifting assets to their parents. What that does is it removes it from the child's estate. It's usually used for assets that have appreciated, so you have a low income tax basis. And what you see happen is you gift it to your parents. It's includable in your parents' estate. And then when they pass away, you re-inherit those assets because it was includable in their estate. You get a step up in income tax basis upon their passing. So you're effectively, taking those assets with a very large appreciation, and you're reabsorbing that appreciation without a tax effect. So then if you were to sell it the next day, your income tax basis would generally be the fair market value on your parents' date of death. So if you sold it the next day, there's generally no appreciation day to day. You could sell assets for no capital gains. Whereas if you would have sold them without this technique, you'd be sitting on very large capital gains. Also, with changing tax laws, there's always going to be confusion. There's always going to be concern, and there's going to be a lot of tax audits and controversy coming out of those. Should you have an issue with a tax audit or a controversy, we here at Cope and Barger are happy to help with that, and can step in and defend you any way we can. So how can Cope and Barger help you through these times of changes? Really, what I would advise right now is schedule a personalized review of your estate and tax plan with one of our attorneys. We can help you understand how today's tax changes may affect you and your family's future. And we can also stress test your plan for today's laws and tomorrow's uncertainty. A lot of what I do is sitting down, looking at some tax plans people have created, more so on the estate and gift tax side of things, and just make sure that they've planned properly. Just like with your basic estate plan, regular reviews for your advanced planning is important to make sure, one, your assets are doing what you expect them to do, whether they're appreciating faster or maybe losing value. You might want to, do some changes to your plans, but you really want to make sure that when you are unfortunately getting ready to pass away and you sit down to review your plan as the final step, that there's no, pitfalls that you didn't see coming, because these all take time, and you need to make sure you're doing everything you can to make sure that you were prepared for, the final stages. Why Cope and Barger and Cope and Barger? We have very qualified professionals here. We've been open since 1979. We have 12 full-time attorneys and 1 attorney of counsel, and over 350 years of combined attorney experience. Several of us here at Cope and Barger hold our advanced tax degrees. Usually that's a Master of Laws in Taxation. We also have certified estate specialists and certified probate specialists. Now, we have a very very qualified and highly motivated support staff of paralegals and legal assistants, and just a diverse staff and diverse skills. We also have 8 different locations throughout California. We can meet you via Zoom, and a lot of us attorneys will generally travel to make sure we're meeting you where you need to be met at. Okay, at this point, we're going to go ahead and start taking some questions. I'm going to pull those up and start seeing what I can answer here. In the meantime, I mentioned beginning, you will be receiving a survey following this presentation. Please let us know how we did. If you have any questions we don't address today, or if we can't get to them all, we will make sure to follow up with you. And then this recording will also be, or this presentation is also recorded and will be available for you later on today at our YouTube, and I believe a copy will be sent to you as well. So with that, let me go through some of our questions. One of the first questions is, what is SALT tax? SALT is just an acronym for state and local taxes. Those are going to be generally state income taxes, real property taxes, any use tax that comes along. So generally what you pay the state in your localities. Not much local income tax here in California. It's more of a New York thing. But SALT stands for state and local taxes. Another question was, we had just updated our estate planning over the summer. Want to know if they're pretty safe with the new changes. If it was done within the last year or so, I would say you're safe. Here at Kopenbarger & Kopenbarger, we anticipated for that. So as long as it's one of our trusts, you're in good shape. If you have any questions, though, please feel free to reach out to the attorney that worked with you. If it's a tax question or issue, generally it will come over my way, and I'm happy to go through that with you. But generally, if you're under that, I would say that kind of $15 million mark, then you should be okay with your estate planning, especially as long as you updated your family situation, made sure everything's titled properly. You should be good. Let's see. The new standard deduction for couples over 65. Off the top of my head, I can't remember what the basic standard deduction level is, but it basically you add $6,000 or $12,000 to that for the couples over 65. And let's see if I can get that info. What was it? I think it's right short of 15,000, but I don't have the exact number off the top of my head. But a quick, I can get that for you if we need to follow up on that. Happy to do so. Let's see. Some folks moved out of state. Do you need to update your trust? What should you do? Give a call to your attorney that helped you here at Kopenbarger, or your attorney if it's a non-Kopenbarger firm. Call the attorney that helped you draft it originally. Generally, they will have someone in your local state or your locality that they know who practices, and they can work well together to get your trust updated. Generally, though, if there haven't been any other major changes to your estate or to your holdings, your assets, your family, most states or all states will enforce California law in the administration of your trust. Things you have to look out for in that situation would be if there's very specific state or local rules when it comes to their estate tax. Some states do have a state tax. California is not one of them. Voters got rid of that a long time ago, and we'd have to vote to bring it back, so probably not happening. But states like Washington, states like New York, et cetera, they're going to have the state taxes. So you want to make sure that you're planning for that, because those limits are generally much lower than here in than the federal limits. So definitely, work to find local counsel. And my suggestion is call your local attorney here in California and figure out, what changes might need to be made, and then work with them to schedule a time to see somebody in your new state. Let me move over to the chat for some of our questions here. Let's see. One of the question is, do I see that the effect of higher personal deductions as a way to discourage charitable contributions? Yes and no. Generally, with most of the clients I work with, the charitable contributions aren't so much governed by a wish for income tax planning purposes. It's definitely a perk. But usually those that, are planning charitable contributions, they're doing so more so out of wanting to give back and wanting to support certain causes and kind of keep that spirit of giving going, especially in your estate plan. If you have an estate plan that sets up either a private foundation or sets up a charitable trust, Usually the goal there is not so much the income tax breaks of it as it's going to be the legacy of giving that you're going to instill in your family and keep that going past your death. Um, Both cash and in-kind donations to charity have long been part of the strategy. Yeah, it's definitely a strategy to reduce tax liability. And it's kind of one of those things where you can do it up until December 31st of the year you're paying taxes for. So you had until, December 31st, 2025 to make charitable contributions that would impact your 2025 taxes. I love to use charitable deductions on an income tax planning side of things, kind of as a last minute, kind of Hail Mary. We know we wanted to give X amount. We know we're hitting a higher tax limit this year. What do we have left over at the end of the year to give? Plan it that way. But usually those that are taking the standard deduction generally aren't giving a tremendous amount to charities in general. Usually, or if they are, if you give enough where it bumps you into the itemized deduction realm, that's a great way to use it for income tax purposes as well. I really enjoyed it a few years ago in the tax. I believe it was the first year the Tax Cuts and Jobs Act came into effect. They were allowing you to take at least, I think it was $1,500 of charitable contributions to use on your tax return, regardless of if you itemized or took the standard deduction. I would love to see a change back to that just because that's going to encourage giving across the board. Let's see. Let's see. Linking trusts with tax planning, financial planning, and estate planning to an overall plan seems like a daunting task, but a necessary task. The elements of these plans generally need an annual review. He said you need some help. Definitely, if you need some help, please definitely, give us a call, set up a consultation. You can go ahead and go onto any of our websites, give us a call and schedule a free consultation to review your estate planning documents or establish new ones. I believe that will also, if you have a tax consultation, that'll float over to me as well, and I'm happy to go through those with you. But yeah, it is definitely a daunting task, especially for high net worth individuals. If we're planning for estate taxes and gift taxes and all those different regimes out there, it's generally an annual process. I like to sit down with my clients probably about every year and a half or so to review, just make sure we're doing everything that needs to be done. And a lot of these plans take more than 1 year to implement in full. So you're generally going to see folks, come in and start a plan, and it'll take us about 5 years to get us where we need to be. And then we're checking in year after year after that just to make sure that everything is going well. The best thing you can do is have just very good coordination between all of your trusted advisors. I love working with financial advisors, CPAs, business managers, whoever it may be, to make sure that your plan is working the way it should be. And it's a good practice for attorneys to make sure they're doing the same for you. Step up versus capital gains, which is, I'm assuming that's going to mean best. So capital gains are basically anytime you sell an investment asset that you've held for a year or longer, you're going to be hit with the more favorable capital gains tax rate, which max out about 20%. So generally, if you hold things for longer, you're paying those long-term capital gains rates. The step up in basis, it's a bit different than that. What the step up in basis does is it moves your investment in that asset. So let's say you bought something at $5 and now it's valued at 20. If you get a step up in basis through proper estate planning, what you'll see is your basis will step up to that $20 if that's what the value is on the date of passing. So it's going to lower those overall capital gains. So utilizing the step up in basis is more so a way to plan for capital gains. So definitely, you want planning that considers both. And there's other assets where you may not necessarily need that step up in basis, or there's types of planning that you do where you're removing some of these appreciated assets from your estate, which is fantastic. But unless there's a way for it to come back in and be includable in your taxable estate, your beneficiaries aren't getting that step up in tax basis. So if they were to sell those assets after your passing, but without that stepped up basis, they're getting hit with high capital gains. There are ways to kind of, I don't like to say have your cake and eat it too, because that's not quite right, but it's pretty close. It's, you can have a piece of the cake. You can't eat the whole thing, but there are definitely plans where you can utilize both the step up in basis and some capital gains tax planning where your beneficiaries are going to pay considerably less in tax after your passing. Or, for example, if it's rental real property that you own that passes down to the next generation, if they get that step up in tax basis, they can also start depreciating that property again, which is a huge income tax break against any rental income. Question on Prop 19 affecting the step up in basis if the children live in the parent's house. So Prop 19 passed a few years ago here in California, which drastically changed how reassessment occurs on real property that's transferring to the next generation. Essentially, post Prop 19, parents are able to pass their basically their primary residence onto their children without there being reassessment if certain conditions are met. And generally, it has to be your primary residence for at least 2 years prior to your passing, and your kids need to use it as their primary residence for 2 years following your passing, and they need to live in there. It needs to be planned that way. In terms of impacting the step up in basis, generally no real impacts Prop 19 has on it, just because Prop 19 is more focused on the real property taxes you're paying to the state and local government, whereas the step up in income tax basis is more on the federal and state income tax side of things. So generally no impact between those two. It really what it comes down to is whether or not the property was includable in your taxable estate or not. If it was, your beneficiaries get that step up in basis. Question on legislative and presidential intent to ease capital gains tax on real estate sales. I've heard of it. There's been some going back and forth. Generally, that was more so discussed during the lead up to the 2024 election. You saw some of it floating around during the legislative discussion for the big beautiful bill, but ultimately it was left out. I've tried guessing kind of what Congress is going to do, what's important to Congress, and what changes they're gonna make. I've tried that for about the last 12 years or so, and every time they kind of prove me wrong, and a lot of practitioners are wrong, where we don't really see exactly what's coming. I don't know if there's been any progress on that, but because they passed such sweeping tax legislation in the first year of the second Trump administration, I wouldn't expect to see many major changes over the next couple of years until we have a new administration take over, unless you see a very large change in the makeup of Congress during the 2026 midterms. If you see a large shift, toward one ideology or the other, you might see taxes come back on the table. Ones that I would predict you'd see, I would imagine the estate and gift unified credit at the 15 million. That one's probably on the table, to be either reduced or even further eliminated. Just because that seems to be one they love adjusting over the last couple of administrations. So I'd expect to see that. With the easing the capital gains, I'm not sure though. If I hear anything though, I will be sure that that type of information starts getting added to Kevin Barker's newsletter. When did and does the big beautiful bill go into effect? For tax purposes, it goes into effect starting for tax year 2025. So for income tax purposes, the provisions are already in place. At this point, we're about to be into February of 2026. The tax filing deadline for 2025 will be April 15th of this year. So you'll start to see those changes this year on your 2025 tax returns. Let's see, there was just a comment that there's also a reduction in charitable contributions for 2026, 0.05% of income and allowance to deduct 1,000 without the itemizing. Oh, perfect. I'm glad that is back. Yeah, and there's generally always going to be limits. It's usually based off your modified AGI. Once you hit a certain level, only 50% deductions. Some types of deductions, only 30%. So each type of gift and when you give the gift, generally strategic. Work that out with your tax advisors, your CPAs, your financial advisors. Definitely work with them to make sure whatever gifts you plan on giving have the most benefit. One of the things I do with my clients is if they want to make, say they usually give about $20,000 a year to charity, but we know there's a big income year coming where either if they are working for a tech startup and they have a bunch of incentive stock options, things like those, or the company's going public, and we know there's going to be a large tax burden, a few years from now. I generally advise, well, let's hold off on, those tax deductions this year. Don't make those charitable contributions. Let's make them a few years from now and bundle them together for a bigger deduction. So just types of planning like that. It's really important just to work through with your tax advisors to make sure that you're getting the most benefit as possible. Let's see. Did I hear correct? The new over 65-year-old standard deduction for a couple is 12,000 more than it was last year. That is correct. You can add 12,000 onto what the standard deduction was. And yeah, your tax preparer should do it. It's on form. It's not on the face of the Form 1040, but I think it's Schedule 1A. You should see that deduction coming in. So definitely make sure your tax preparer knows about it. Pretty much everybody does. If they're using software, most software accounts for it automatically. But definitely, give it a check, make sure it's on there. Do family get the step up basis on the stock owned? So the step up in basis goes to whoever the person that inherits the asset is. So let's say you have a married couple here in California, we're a community property state. Let's say they own a home together. It's titled in joint tenancy, or it's owned by their living trust as community property. When the first of those spouses passes away, the surviving spouse is, inheriting that property from their deceased spouse. They're going to get a step up in the income tax basis at that time to the fair market value. And then when that person passes away, whoever their beneficiaries are, whoever inherits that asset from both decedents, they're going to get another step up in income tax basis at that time. So it's not necessarily family. It's whoever it eventually inherits it. It could be friends, it could be, cousins, it could be whoever. The important part there is whether or not it's what's called includable in your taxable estate. What that means is, you don't necessarily have to pay estate tax on it if you're below that $15 million exemption level. Then it just kind of the tax gets written off. But if it's inside your estate, possibly subject to tax, but for that exemption, generally you will get that step up in tax basis for your beneficiaries. Accelerated depreciation. It's a bit beyond the scope of this conversation. But essentially, depreciation is where you take an income tax deduction for the value of an asset over its useful life. For example, real property, it's supposed to have a useful life of 27 and a half years. So you deduct, say you bought a home for $1 million, you divide that by 27 and a half, and then you take that amount of deduction each year for 27 and a half years until it's fully depreciated. Accelerated depreciation, it allows you to kind of speed that up for different asset classes and take it a bit sooner rather than later. Good technique in early years when you don't, you're going to have a lot of income in the beginning years, but you can kind of space that over time. But really, kind of beyond the scope of this, if it's something you are concerned about, or if you need it kind of built into your planning, if you don't already have a tax advisor, a CPA, or a tax preparer you're working with, and you're looking for our help, go ahead and schedule a consultation. I'm happy to sit down with you and talk about that offline. Okay. I am not seeing any further questions at this time. We're going to go ahead and leave this open. If you have any other questions, feel free to get them in there. Like I said, please fill out our survey link. If you would like to schedule a consultation, please do so. You can give us a call, go to our website, email us, just reach out, and we're here and happy to help you. Thank you all for attending, and we will see you next time. Oop, one quick question that I saw come in before I ended here today does it make sense to have stocks in the trust name? Generally, yes. You want your brokerage accounts to be titled in the name of your trust. Your revocable living trust generally is subject to estate tax. Your beneficiaries will get that step up in income tax basis. So you definitely want to have your stocks titled in the trust name, and that's more so to avoid probate. Here in California, assets over, I believe it's like 202,000 or so are subject to probate, which is timely, expensive, and you don't want your friends and family to go through that. So title your assets in the name of the trust to avoid probate. Call your attorney to make sure it's done right and to make sure that everything's accounted for. And I'll jump back on for one last question. How do taxes affect a B trust? Um, if things are already in a B trust, it usually means that you have one decedent already. There's none of these changes are generally going to impact a B trust that's already been funded. Um, I think you probably have a more specific question than that, so I would advise you to give us a call. I would like to see the B trust and kind of exactly what you're talking about, so I can advise you of any, impact on that. So please feel free to go ahead and give us a call. All right, and with that, I'm going to wrap up questions. If you have anything else, please feel free to email us, and we'll get back to you offline.